When shipping goods by sea, it is important to consider who covers the cost of transportation as well as insurance. Today, we will examine in detail the CIF, cost, insurance, and freight delivery method, where the seller bears the cost, insurance, and freight charges. CF is a delivery method in which the seller loads the goods on the ship at the port of export and bears the transportation costs and insurance until the port of destination. The risk passes to the buyer as soon as the goods are loaded on board. The seller provides transportation costs as well as minimum insurance coverage. Thus, the buyer has some assurance against damage that may occur while the goods are in transit. The seller completes export customs clearance, loads the goods onto the ship, and pays the freight and insurance. However, if the buyer wants to take out more comprehensive insurance, this can be added on top of the insurance provided by the seller. CF applies only to maritime and inland waterway transportation. As the risk passes at the moment of loading, it is important to have a good understanding of the safety of the goods and the insurance coverage. Let's give an example. A company sending textiles from Izmir to Canada sells on CIF Vancouver terms. The company loads the goods onto the ship at the port of Izmir and covers the freight and insurance costs. Although the risk passes to the buyer at the time of loading, any damage that may occur during transportation is covered by insurance. The buyer takes care of the delivery of the goods when they arrive. In Canada, CIF provides a significant convenience to the buyer by offloading the cost, freight, and insurance of maritime transportation to the seller. However, the moment of risk transition and insurance coverage should be well evaluated